So as we continue on, we're going to start talking a little bit about those performance evaluation systems and specifically the balanced scorecard. So the balanced scorecard is I'm going to use the word relatively new concept. And by relatively new, I mean in the last 30 to 40-ish years, which in accounting is relatively new. But it's an idea that as we start to evaluate our company, as we start to evaluate divisions and departments, we want to make sure that we are taking a balanced approach. We want to make sure that we're looking at all of the important factors and not just zeroing in on one. Okay, so as we again decentralize, we have to have a way of evaluating how are our departments, our divisions, our segments, our campuses doing. And so we develop some sort of performance evaluation system. And I'm certain that you all have some experience with a performance evaluation system based on where you work or something like that. So somehow you're being evaluated, your managers are being evaluated, they're in turn evaluating you. We're trying to make sure that everyone is it's a way to maintain control and make sure that everyone is working for the betterment of the organization. So the goals of any performance evaluation system is, again, I'm going to go a little bit out of order here. We want to use it as a way to communicate expectations. So if you know that this is something that you're going to be evaluated on, you now know that this is an expectation for you. You are now expected to meet this goal or exceed this goal. So it provides a way for benchmarking also. It sets a standard of performance that you're expected to meet, and this now has been communicated to you, so you know that you're expected to meet it. So one of the things that I have to do in my role at TCC is I have to evaluate other instructors. I have to go sit in their class, usually once a year, and watch them teach, and there's this big form that I have to fill out. So when I hire a new instructor, I immediately, after I've got them in place and got all the paperwork, is I send them this form that I'm going to be filling out. So I can say, here, when I come to evaluate you, you will know up front all the things that I'm looking for. So I've communicated the expectations of what I expect to see in class, good interaction with the students, good communication skills, all of that sort of thing. And I'm providing a benchmark. Here's the level that we're expecting to see. This performance evaluation also gives me a way to provide feedback. So I fill it out as I watch the instructors teach and I watch them interact with the students. And then afterwards we have a meeting. We sit down and we have a meeting and I tell them the things that I saw in the class that I thought they did really well, and I provide um, some advice of some things that I think that they could try, maybe things that might work well, maybe things they should perhaps consider adding to their class, but I provide some feedback. This is intended, if a performance evaluation system is done right, it's intended to be motivating, right? It's intended to help you come out and be better at your job. Now, I'm sure that we all have stories that we could sit around and tell of terrible managers who were not good at doing this, and we left them feeling worse, and it was really more of a punishment than a motivation. But if done well, and if done correctly, and if implemented correctly, these performance evaluation systems should be a source of motivation. They should help you be better at your job. But certainly not least, these performance evaluation systems should help us to provide goal congruence and coordination. So again, we are all working towards the same goal. We're all working towards this common goal, and we know this. We've communicated this, so we all know where we're working together and how we're going to get there. Now, we tend to, especially in business, focus a lot on financial aspects. We want to see, did we meet budget? Did we exceed budget? Did we come in under budget? If we were over budget, whose fault was it that we were over budget? And certainly finances are an important part of that. But the thing is, financial performance measures are what we call lag indicators. In other words, they tell us what has happened in the past. They don't necessarily tell us what's going to happen in the future. They're not lead indicators. Usually if we do use them to predict the future, it's a short-term future, not a long-term future. So while we want to use these performance measures, just because we were over budget in the past last year, that doesn't really tell us how to fix the problem going forward. So we want to take a more expansive, a more comprehensive view of things and use what we call operational performance measures. These are non-financial measures, so they incorporate non-financial measures that help us include all of these things that promote efficiency and effectiveness, because it's not always just about the dollar. Maybe we have changed our operations so that we are more environmentally friendly, but it's going to be a little bit more expensive because we had to buy some new equipment. It's going to save us money in the long run, but in the short run, we went over budget. So again, just to give you a personal example, I had to replace my air conditioner system. Whew, it was really expensive. Lots and lots and lots of money. Really blew my budget. I have a small budget set aside for things that home repairs, but wow, I was not planning on having to replace that air conditioning system. But because my house is old and the air conditioning system is really old, it wasn't working very efficiently. So even though I spent a lot of money on this new air conditioner, I got a much more efficient system that has already started lowering my electric bill. So in the long run, this system is not only more efficient, so it's better for the environment, but it's also going to save me money in the long run. But in the short run, I look like I totally went over budget last year and I spent way too much. So these operational performance measures kind of take us, even these financial measures, and they incorporate these non-financial, and they help us keep that more long-term view. So again, as we get into the balanced scorecard, the idea is that you're going to take a balanced view of all of the things that are important. Now, the Balanced Scorecard Institute, pardon me, and you can go to their webpage. They've developed really 4 basic kind of areas to look at. Now, as companies implement these, they may add more to them. I've seen companies with as many as like 12 and 15. I've seen lots of companies that go with like a 6 to 7 sort of areas, but they've developed these but the basic package, so to speak, is 4 basic areas, 4 things that we want to keep in perspective. And then we identify what we call key performance indicators. These are the metrics that we're going to use to measure how we're meeting these 4 areas. So the 4 basic views, the 4 basic perspectives are the financial perspective. Certainly we're not going to exclude the money side, it's important. The customer perspective, internal business, and then learning and growth. So let's walk through each of these 4. So the financial perspective is just what you think it is. It is looking at how we can increase profits, increase revenue growth, save cost, increase productivity, right? So it are common key performance indicators, and every company will choose their own, but some common ones would be net income, sales revenue growth, gross margin or gross profit growth, cash flow. So looking at, maybe your cash flow from operating activities, return on investment, residual income. We'll talk about those 2 in the next learning objective. Now, the customer perspective is looking at improving customer satisfaction. So the idea is that if we want to stay in business for a long time, we have to have happy customers. Happy customers are going to buy from us. Angry customers aren't. So how can we measure and make sure that we're keeping our customers happy? Well, one way is customer satisfaction ratings. Have you noticed in the last few years that you now get a customer service or customer survey after just about everything? This is why those companies have implemented a balanced scorecard, and they're wanting to survey you and try to capture that data from you. We can also measure it as percentage of market share, increase in number of customers. So how many new customers do we have? How many repeat customers do we have? How many customer complaints do we have? What do we have? How much sales returns do we have? Okay, so if customers are unhappy with our quality and they start we see sales returns go up, that's an indication of our customer perspective. So internal business is looking at our internal efficiency and effectiveness. So what do we do internally and what can we do internally to try to be more efficient, to be a better company? So we could look at, again, lots of things here that companies could choose. We may look at number of new products that we've developed. We may look at our cycle time. How long does it take us to make a product? Is that going up? Is that going down? How is it compared to industry? What's our defect rate? So we talked about internal failure in the last chapter. How many internal failures are we having? If we can cut those down, then we could improve that would make us more effective, right? How many warranty claims do we receive? So not just sales returns from unhappy customers, but warranties because of those external failures that we have. What's the average repair time? How long do customers have to wait for a customer service representative? Now, yes, that would also lead to the customer perspective, because if I'm on hold for 2 hours, then I'm a very unhappy customer, right? So a lot of these are intertwined here together. They're related. And then finally, learning and growth. This is again looking at our internal businesses, but really from the perspective of our employees. So what can we do for our employees to make our company better? So how many hours of employee training do our employees have? How many number of cross-trained employees do we have? What about employee satisfaction surveys? Our employee turnover? How quickly are employees leaving? How long do they typically stay with us before they move on to a better job? These are things that we want to be looking at. If we're not keeping employees, or we find that there's one position or one department that we really just can't keep employees in, then that should be a clue to us that, hey, maybe there's something there that we need to look at.